When I first started trading, I believed the hardest part would be understanding the market. I thought success would come from learning charts, indicators, and strategies. If I could just study enough, find the right system, and read the market correctly, eventually everything would fall into place. So whenever I lost money, I assumed the solution was simple. I needed a better strategy. I would search for new indicators, try a different system, or learn another trading method. Each time I discovered something new, I felt hopeful again. It always seemed like I was one idea away from finally figuring it out. And this pattern repeated itself again and again. A few losses would appear, and immediately I would question the strategy. Then the cycle would start over, new indicators, new systems, new approaches. At the time, it felt logical. If something didn't work, you replace it with something better. But after years in the market, I started to realize something uncomfortable. The strategy was never the real problem. Two traders could use the exact same method, looking at the exact same chart, and still produce completely different results. One could remain disciplined and consistent, while the other would slowly destroy their account. The difference wasn't the strategy. It was how they behaved under pressure. That realization changed the way I looked at trading completely. Looking back now, there are a few things I wish someone had explained to me when I first started trading. Ideas that would have saved me years of frustration, confusion, and unnecessary losses. In this video, I want to share those lessons, not as theory, but as things I learned the hard way through experience. I entered the market at the end of 2019. At that time, trading didn't feel like a profession to me. It felt like an opportunity to change my financial situation faster than a normal job ever could. Like many beginners, I believed trading could be a path to financial freedom. I imagined that if I could learn how the market works, if I could read charts correctly and catch the right moves, the profits would eventually come. The idea seemed simple enough, but the reality was very different. During that first year, almost everything I did was driven by emotion. I traded based on excitement, curiosity, and sometimes pure intuition. There was no real system behind my decisions, no real understanding of probability, and most importantly, no real respect for risk. Some trades worked, and those wins made me feel confident. But when losses came, I didn't really know how to handle them. Sometimes I held losing trades for too long because I hoped the market would turn. Other times I entered trades too quickly because I didn't want to miss the opportunity. Over time, the small mistakes started to accumulate. One bad trade became two became five, and slowly, the account began to shrink. At first it didn't feel serious. I told myself it was just part of the learning process, but eventually the losses became impossible to ignore. By the end of that first year, I had lost my entire savings. Looking back now, that moment was painful, but it was also necessary. It forced me to confront a truth I hadn't been willing to accept before. Trading was not as simple as I had imagined, and the market was not going to reward enthusiasm alone. That failure pushed me into the next phase of my journey, a phase that many traders experience after their first big loss. The phase of endless studying. After losing my entire savings in the first year, my reaction was very predictable. I started studying, but the way I studied was shaped by a belief that most beginners share without even realizing it. I believed the problem was technical. If I lost money, it must mean my analysis was wrong. If my analysis was wrong, it meant I needed a better method. So naturally, my attention went towards strategies, not psychology. At that time, psychology didn't even feel like a real factor. It sounded abstract, almost secondary. The market looked like a technical puzzle: charts, patterns, indicators, structures. It seemed logical that if you could just understand those things well enough, consistency would eventually follow. So I started building methods. First it was indicators. RSI, MACD, Bollinger Bands. I experimented with combinations, trying to find signals that felt reliable. Then I moved deeper into price action and market theory. I studied market structure, support and resistance, Dow theory. Later I explored more advanced frameworks like Elliott Wave, Wyckoff, and eventually concepts like I Roman 11 and smart money. Every new one felt promising. Every new system came with explanations that made the market suddenly appear clear. And every time I learned something new, it felt like I had finally discovered the missing piece. But there was a pattern I didn't notice at the time. Whenever a strategy started losing, I assumed the method itself was flawed. So I replaced it with another one. The cycle kept repeating. In reality, I wasn't refining a skill. I was constantly resetting the learning process. Looking back now, it makes sense why psychology never became my focus during that phase. Strategies are visible. They feel concrete. You can draw them on charts, write rules, test them. Psychology, on the other hand, is uncomfortable. It forces you to look inward instead of outward. and for a long time, I wasn't ready to do that. So the years passed in a strange loop. I wasn't losing money as recklessly as before, but I also wasn't truly consistent. Some days I would have good weeks, occasionally even good months. But sooner or later, something would break the rhythm. One emotional decision, one impulsive trade, one moment of frustration, and suddenly a large portion of the account would disappear. The turning point came after another painful loss. I had spent years studying, testing strategies, trying to refine my approach. I believed I had finally built something solid, but one sequence of trades went wrong, and instead of staying disciplined, I reacted emotionally. I increased risk, I tried to recover quickly, and within a short period of time, the account was gone again. That loss hit differently. Not because it was the first time I had lost money, but because by then I believed I should have known better. For the first time, I didn't immediately jump back into the market. Instead, I stopped trading completely for a while. During that break, I started reviewing my entire journey from the beginning. I looked at my trades, my decisions, the moments where things went wrong, and slowly a pattern began to appear. Most of my biggest losses didn't come from bad strategies. They came from bad reactions. Moving a stop loss, closing a trade too early, taking trades that weren't part of my plan, increasing position size after a loss. None of those mistakes were technical. They were psychological. That realization changed the direction of my learning completely. For the first time, I stopped asking, which strategy works best? And I started asking a much more uncomfortable question. Why do I keep sabotaging my own system? That question stayed in my mind for a long time. Why did I keep breaking my own rules? Because the strange thing was this. By that point, I actually understood many trading concepts. I knew where my entries should be. I knew where my stop loss should go. I even had a structured way of looking at the market. But when real money was involved, something changed. The moment a trade went slightly against me, the plan started to feel less certain. Doubt appeared. I would start watching every small movement on the chart, trying to interpret what the market was really doing. And slowly, the rules I had written down began to lose their authority. Sometimes I moved the stop loss because I believed the market would turn around. Sometimes I closed winning trades too early because I was afraid of losing the profit. Other times I entered trades that weren't part of my plan simply because the move looked too good to miss. Technically, the system was still there. But emotionally, I wasn't following it. That was when I started to understand something fundamental about trading. Trading is not only about analysis, it's about behavior under uncertainty. The market constantly places you in situations where the outcome is unknown. Even when you have a good setup, you cannot know for certain whether the trade will win or lose. And the human brain is naturally uncomfortable with that kind of uncertainty. It wants control. It wants confirmation. It wants to avoid being wrong. So when the market moves against you, your brain starts trying to protect you from that discomfort. It searches for ways to reduce the feeling of loss or uncertainty, even if those reactions destroy the trading plan. That's when I realized something that completely changed the way I approached trading. My biggest losses were not caused by bad analysis. They were caused by emotional reactions to uncertainty. And once I saw that pattern clearly, my focus shifted. Instead of constantly searching for a better strategy, I began paying attention to something much more important. My own decision-making process. I started observing how I reacted when a trade was losing, how I behaved after a winning streak, how frustration or overconfidence influenced my position size and risk. The more I paid attention to those patterns, the clearer the real challenge of trading became. The market itself wasn't the hardest part. The hardest part was managing my own mind while interacting with it. That realization marked the beginning of a completely different stage in my trading journey. Instead of asking how to predict the market more accurately, I started asking a different question. What kind of mindset allows a trader to survive long enough for probability to work? And the answers to that question eventually turned into a few lessons that changed everything for me. Looking back at the entire journey, there are a few lessons I wish someone had explained to me when I first started trading. Not as motivational advice, but as practical truths about how the market really works. These ideas sound simple now, but understanding them earlier would have saved me years of confusion. The first lesson is that trading is a probability game. In the beginning, I treated every trade like it had to be right. When a trade lost, it felt like I had made a mistake. That mindset created a lot of emotional pressure because every outcome suddenly felt personal. But the reality is that even a good setup can lose. A strategy with an edge might win only 50 or 60% of the time. Once you truly accept that, the emotional weight of each individual trade becomes much smaller. The goal is not to be right every time. The goal is to execute the same edge consistently over a large number of trades. The second lesson is that risk management matters more than strategy. When traders begin, most of their attention goes to finding the perfect entry. They spend hours analyzing charts, searching for the exact moment to enter the market. But professional traders think differently. They focus on risk first. How much of the account is exposed in each trade? How much can be lost if the idea is wrong? How to make sure that a series of losses cannot destroy the account. A strategy without proper risk management will eventually fail, no matter how good the entries look. The third lesson is that the human brain is not naturally designed for trading. Our instincts evolved to avoid uncertainty and protect us from danger. But trading requires the opposite behavior. You must accept uncertainty and act calmly even when the outcome is unknown. This is why emotions like fear, greed, and hope appear so strongly in trading. They are not signs of weakness. They are natural reactions of the brain trying to protect itself. But if those emotions control your decisions, they slowly push you away from your own system. The fourth lesson is that small accounts create bad habits if you are not careful. When the account is small, it is easy to treat trading like a shortcut to fast money. Traders increase their position size, chase big moves, and hope for quick growth. The problem is that this mindset encourages gambling behavior. Instead of focusing on consistency, the trader starts focusing on dramatic results. And in most cases, that leads to large losses. The fifth lesson is something that took me the longest to understand. Consistency is not created by a strategy. It is created by behavior. Two traders can use the same method and produce completely different results. The difference is not the chart analysis. It is whether they can follow their rules through both winning and losing periods. Consistency comes from repeating the same disciplined process again and again, even when emotions are pulling you in another direction. Once I started to see trading through this lens, many things that once seemed confusing became much clearer. The market itself had not changed. What changed was the way I approached it. And that shift eventually led to the most important realization of all. When I look back at the entire journey, one thing becomes very clear. The market itself did not change. What changed was the way I understood it. In the beginning, I believed trading was mainly about knowledge. I thought success would come from learning more indicators, discovering better strategies, or finding the perfect system. But over time, I realized that trading is much less about prediction than most people think. It is about managing uncertainty. The market will always move in ways that are impossible to fully predict. Even the best analysis cannot remove that uncertainty. What separates consistent traders from everyone else is not their ability to forecast every move, but their ability to operate calmly within that uncertainty. They accept losses as part of the process. They control risk before thinking about profit. And they focus on executing their plan instead of reacting emotionally to every movement on the chart. That shift in perspective took me years to develop. It required losing money, questioning my own assumptions, and stepping away from the market long enough to examine my decisions honestly. But once that understanding began to form, trading started to feel very different. The pressure to be right disappeared. The focus moved from individual trades to long-term consistency, and the market no longer felt like something I needed to defeat. Instead, it became an environment where patience, discipline, and self-awareness mattered far more than any single strategy. If there is one idea I wish I had truly understood when I first started trading, it is this: trading is not a battle against the market. It is a process of learning how to manage yourself while interacting with uncertainty. And once you begin to see trading that way, the entire journey starts to make much more sense.